Okay, let's dive into this. We're looking at crypto trading platforms today based on the sources you sent over. And on the surface, it seems pretty simple, right? Find a place, buy some crypto, sell some crypto.
Yeah, it sounds easy. But the sources, they really hammer home that choosing the wrong platform, well, it can go sideways fast. It can turn excitement into, frankly, a disaster.
Definitely. It's not just theoretical risk either, is it? The sources mention some specific, pretty harrowing stories.
They really do. There's this guy, Jacob, who lost like 30% of his crypto because the platform he used got hacked, not secure enough.
Ouch. 30% is painful.
And maybe even worse, there are stories of people losing everything because a platform that looked totally legit, totally reputable, just went bust, bankrupt.
Wow. Okay, so those are serious warnings. It's clear this isn't just about convenience. It's fundamentally about protecting your assets.
Exactly. In a space that's, still evolving so quickly.
And the sources seem to point towards a core principle. They call it a golden rule, something absolutely critical.
Absolutely. We have to start there. It's the foundation for everything else the sources talk about. And they're really blunt about it. Not your keys, not your coins.
Not your keys, not your coins. Okay, that sounds important. What does that actually mean for someone, using one of these platforms day to day? What are these keys?
Right. So think of your crypto like this. It's controlled by a pair of digital keys, a public one, like your email address that you can share, and a private one, like your password, which proves ownership.
Okay, public address, private password. Got it.
Whoever holds that private key truly owns the crypto. Now, when your coins are sitting on a trading platform, usually you don't hold that private key. The platform does.
So even though I see my balance on the screen, I don't technically have full control.
Precisely. It's a bit like money in the bank versus cash in your hand. You trust the bank, but they physically hold it. If that crypto platform gets hacked or folds or freezes your account for some reason,
my access could be gone.
Yeah.
Because they hold the keys.
Exactly. That's the risk. So the sources are really strong on this point, almost like a mantra. Finish your trade, then get your coins off the platform, move them to a wallet where you control the private keys. Always. No matter how much you trust the platform.
Okay, that golden rule is loud and clear, especially after hearing those stories. Control your keys. So let's back up a bit. What exactly are these crypto trading platforms? The sources use a few analogies.
Yeah, they're essentially the digital bridges, the gateways connecting buyers and sellers of crypto. One source compares them to traditional stock exchanges like the NYSE, but for Bitcoin, Ethereum, all those digital assets.
Makes sense. A stock exchange for crypto.
Or maybe simpler, just think of them as online marketplaces. Specialized markets for digital stuff.
Okay, a digital marketplace. And your sources say there are basically three main kinds of these marketplaces.
That's right. Three main types. First up, the ones most people probably know. Centralized exchanges or CEXs. Think Binance, Coinbase, the examples given.
Right, the big names. How do they work?
They act as the middleman. You deposit your money or crypto onto their platform, you place an order, and they match you with someone else using their platform. They handle the transaction.
So they're kind of the established players, often regulated.
Generally, yes. And the big advantages the sources point out are, one, they're usually pretty easy to use, familiar interfaces like banking apps. And two, really important, they have high liquidity.
Liquidity meaning?
Meaning lots of buyers and sellers are active. So it's usually quick and easy to buy or sell, even large amounts, without the price jumping around too much because of your trade.
Okay, easy to use, easy to trade. What's the downside?
The main trade-off is you usually have to register, do the whole know your customer thing, KYC, uploading ID, personal info, so less privacy. And crucially, that custody issue we just talked about if you leave your coins there.
Right, back to the golden rule. Okay, convenience and liquidity, but KYC, and you don't hold the keys on the platform. What's the next type?
That brings us to decentralized exchanges, or DXs. Names like Uniswap, SushiSwap pop up in the sources. These run directly on the blockchain. No central company holding your funds or acting as that direct intermediary.
Huh. So how does trading happen without a central company?
Well, instead of depositing funds to the exchange, you usually connect your own crypto wallet directly to the DEX's system, which is often run by smart contracts, automated programs on the blockchain.
Interesting. So you interact with it, but don't hand over your funds to it in the same way.
Exactly. Trades happen more directly, maybe peer-to-peer through the protocol, or using these things called liquidity pools, the big pluses. More privacy, usually no KYC. And you keep control of your assets in your own wallet during the interaction.
That sounds good. It addresses the key issue. What are the drawbacks then?
The sources flag that they can be, well, quite a bit more complicated for beginners. You're dealing with blockchain transaction fees, directly gas fees, and the interfaces might feel less intuitive than a CEX. It's a steeper learning curve.
Okay, so DEXs. More control, more privacy, but trickier to use, different fee structures. Got it. And the third type.
The third type is peer-to-peer or P2P platforms. Local Bitcoins was the example given. These basically just connect individual buyers and sellers directly.
So less like an exchange, more like a matchmaking service for crypto trades.
Yeah, sort of like classified ads, but with maybe some built-in tools like escrow to hold funds during the trade. Your sources say they're often useful in places where maybe regular exchanges face restrictions or don't support local payment methods.
Flexibility, then, is the main advantage.
Flexibility in payments and access, yes. But the big downside flagged is security. While the platform might offer escrow, you're dealing directly with another person. That introduces counterparty risk, the risk that the other person won't follow through. You need to be more cautious.
Okay, so 3 flavors. CEX Central, easy, liquid, KYC, custody risk. DX decentralized, you keep keys during use, private but complex. P2P direct deals, flexible, but potential counterparty risk. That maps it out. Now, how do you actually choose? The sources bring in a quote here from Robert Kiyosaki.
Yeah, the smart investor doesn't make big decisions based on small information. It's the perfect setup because the sources then list out the crucial things you have to research before you pick any platform. It's not about finding the best one, but the best one for you.
Right. Avoid making big decisions on small info. So what's the essential info we need, according to the sources? What's on the checklist?
Top of the list, security. And this isn't just about checking for two-factor authentication, 2FA. You need to dig deeper.
Like what?
Has the platform ever been hacked? How do they respond? Do they have insurance or like a user protection fund, sometimes called SayFU? And what does it actually cover? What are their specific security practices? The sources imply you need proof of a strong security track record.
Absolutely critical, especially thinking back to that Jacob story. Okay, security first. What's next?
Fees. This is huge. Platforms charge fees for deposits, withdrawals, and trades. And they vary a lot. The sources really stress that even tiny percentage differences add up over time, especially if you trade often.
Yeah, those little bits can really eat into profits.
Totally. So you need to understand the whole fee schedule. Is it flat fees, percentages? Do fees go down if you trade more? Are there different fees for making versus taking liquidity? Get the full picture of costs.
Check the fine print on all the fees. Got it. What else?
Available currencies. Sounds obvious, but, does the platform actually list the specific coins you want to trade or invest in? Some list thousands, others just the big ones. Don't just assume.
Got to make sure they actually sell what you want to buy. Makes sense.
Exactly. Then liquidity. We touched on this. It's about the trading volume. High liquidity means lots of activity, so your trades happen fast and near the price you expect.
And low liquidity means?
Low liquidity can cause slippage. If you place a big order, you might push the price against yourself as the order fills because there aren't enough counter orders right at your desired price. So for smooth trading, especially larger amounts, high liquidity is better.
Okay, so volume matters for smooth execution. Next.
User interface. How easy is it to use? The sources highlight this, especially for newcomers. A confusing platform isn't just frustrating, it's risky. You could easily make a mistake, wrong order type, wrong amount, send crypto to the wrong place.
Yeah, bad UI could lead to costly errors.
Definitely. A clean, intuitive design helps prevent that. And lastly,
what's the final checklist item?
Customer service. Often ignored until something goes wrong. But imagine a deposit doesn't show up or a withdrawal is stuck. Having good, responsive support can be vital when your money's on the line. The sources suggest trying to get a feel for their support before you actually need help urgently.
Security, fees, coins, liquidity, usability, and support. Okay, that's a solid research list based on Kiyosaki's idea. And after doing the homework, the sources suggest a smart way to actually start using a platform.
Yes, a really practical strategy to reduce risk. Start small. Don't just dump your whole investment in at once.
Test the waters first.
Exactly. Deposit a small amount you don't mind risking. Make a trade or two. And, this is key, test the withdrawal. Can you actually get your crypto back out easily and into your own wallet? Go through the whole cycle: deposit, trade, withdraw before you commit significant funds.
That makes total sense. Verify you can get your money out before putting a lot in. It really tests their system end to end.
Right. And this whole process underscores that there isn't one best platform for everyone. It really depends on your needs, as the sources point out.
How so?
Well, are you a super active trader? Then maybe low fees and advanced charts are your priority. Are you more of a long-term buy and hold investor? Then maybe top-notch security and simplicity matter most. You weigh those checklist factors differently based on your own goals.
Align the platform to your strategy, which ties into another quote the sources use from Warren Buffett this time.
Risk comes from not knowing what you're doing. It just sums it all up, really. The risks, like Jacob losing his funds, are way higher if you jump in without understanding the platform, its rules, its fees, its security model, and crucially, that core idea of controlling your assets.
So, know the platform, read the terms, start small. It's about being informed.
Exactly. Diligence is key.
Kiyosaki saying get informed, Buffett saying know what you're doing. It all points to research and understanding. And this brings us right back to where we started, doesn't it? That foundational golden rule gets the last word in your sources.
It does. The most crucial reminder, repeated loud and clear, it's not your coins if you don't have your keys. The final piece of advice is simple. Don't treat exchanges like long-term storage. Use them to trade, then move your assets out, promptly, to your own secure wallet where you hold the keys.
Right. So, to quickly recap the core advice from these sources, research is paramount security, fees, usability, tailored to your needs. Start small, test the full cycle, especially withdrawal, and never forget the golden rule. Get your keys, get your coins, move assets off the exchange after trading.
It's that balance, isn't it? Use the platform's convenience for the trade, but rely on your own custody for security.
Puts the responsibility and the control back with you. And interestingly, the sources kind of hint that this platform choice is just step one. They suggest that really getting to grips with the language of crypto, understanding the core concepts, is vital for navigating this whole space safely.
Yeah, it leaves you thinking that knowing terms like private keys, smart contracts, liquidity, maybe even gas fees, it isn't just academic, it's practical knowledge you need to operate confidently and avoid the pitfalls, building on that foundation of picking the right platform and ultimately controlling your own assets. It's an ongoing learning process in this field.